first off, the headline number at 0.4 annualizes to 4.8%. That's 2 full percentage points above where it was running in the 12 months prior. It's also 2.8 percentage points above the Fed's target. So that hardly struck me as cause for celebration. And, the real reason, obviously, the markets were excited was the core number, which was a little softer. But I thought it was kind of interesting that on the same day the market celebrated this slightly cooler core inflation print, as if they live in a world where no one needs food or energy, oil prices hit $80 a barrel. Whatever cooling there was in the energy component obviously is temporary. Admittedly, oil prices are back down to like $77 a barrel now. But I think it's noteworthy that a lot of smart people have been forecasting that oil prices would head lower, and they have refused to do so despite a global slowdown in economic activity. And on the same day that this CPI number came out, a ceasefire deal announced in Gaza, and then a new administration that comes in and promises to end the war in the Ukraine. So all those things would seem to be reasons to send energy prices lower. And in fact, they are trending in the other direction. So long story short, I think that the markets were wildly amiss in terms of celebrating this or spiking the ball in the end zone that inflation has been vanquished and now the Fed has free rein to continue on its way with rate cuts. And so I anticipate that the massive rally we saw in bond yields on this CPI number and the attendant rise in equity prices associated with it will probably reverse in the days and weeks to come as we see those higher energy prices start to creep into the gasoline price, and eventually that will be reflected in the inflation numbers going forward. It also bears note that if you overlay overall CPI chart with oil prices, or even the core number with oil prices affect everything. So even if you're stripping energy from the CPI, higher oil prices will drive up the price of everything else. We know that. And yet, for some reason, we have this practice of assuming, well, it's just oil, therefore it doesn't matter. Outside of labor, it's the number one input into everything we consume. So even if you're not talking about gasoline that you're putting in your tank or using to heat your home, you buy a box of cereal and they're 50% of the cost of the box of cereal. That's my number, but a large percentage of the cost of the box that you purchase is energy prices, whether it be the energy to actually, till the fields and then, create the product and then put it in the package, and the lining of the box, that plastic sleeve has oil in it, and then getting it to the store and, et cetera, so on and so forth. So, and I guess I would also point out in that food thing, food prices hit a record high. And then there was someone who's forecasting that egg prices are going to go up another 20% over the rest of the year. So again, this celebration seemed wildly premature, but ultimately what it really comes down to is not whether inflation's running at 4 or 3 or 2, it's where it's running relative to the consumer's income. And that continues to be a major issue that has not been overcome. In the latest Michigan sentiment survey, the number of people who expect that their income will actually outpace inflation this year fell to the lowest since the great financial crisis. So they're not optimistic that they're going to real income gains, and that presumably will serve to dampen their spending. And that's one thing, we did see the retail sales number a couple days later, and there again, so we had a 0.4 increase in retail sales. Well, that's exactly equal to what inflation was up. So if you buy the government accounting of inflation, you're saying people didn't increase their spending at all in that month. I mean, they bought the same amount of stuff, actually kept up with the cost of everything going up. So that's another moving part to this drama, is the assumption that the consumer now is going to start to accelerate his spending. And, that rests on the idea that they're going to put the spending cart before the income horse. And they had been doing that. They had been running up credit card debt, but in the latest numbers we got on that, credit card borrowing collapsed. Huge decline in revolving credit in the latest month. So none of this adds up, to ratify the narrative that the markets seem to be running with right now. One would presume that no one was borrowing on their credit card at 23% interest rates because they wanted to. You have to assume that people who are borrowing at that kind of exorbitant rate are doing so because they have no choice. And that kind of conclusion is sort of bolstered by what we've seen in the trend in multiple job holders and how people have had to work 2 and 3 jobs just to make ends meet. But also, when you compare what's happening with credit card borrowing versus the real retail sales activity that I referenced earlier, when people are slowing their unit spend and increasing their credit card borrowing, that's obviously a real warning sign. It'd be one thing if they were increasing credit card borrowing and spending more or taking a vacation, or if confidence was soaring at the same time. But these are not things that we're seeing right now, quite the contrary. I think this really brings me back to 2016 when Trump won the first time. And you did see at that point, we were coming off of a really bad corporate credit crisis that was weighing on corporate profits and hiring and was hitting, obviously, consumers and confidence, et cetera. And then when Trump won and started implementing these pro-growth policies and the tax cuts and whatnot, the economy basically turned on a dime. So I think Wall Street's analysis has been, well, we just replay the tape to 2016, and if he implements the same policies, we'll get the same outcome. The problem is that valuations in 2016 were nowhere near where they are today. In fact, for the better part of 18 months going up to the election in November of 16, the S&P had gone nowhere. It had basically been dead money for 18 months. I mean, you couldn't come up with a more stark difference from today, where the markets have basically been flying, as you said. So, even if you believe that all these policies will be enacted in the form that has been described and everything will be smooth sailing, at what price should assets deserve to trade? I mean, has this all been fully discounted at this point? And I would suggest it has been, and then some, because it's pretty clear already that it's not going to be as easy to get these programs implemented as Wall Street has imagined. We saw that in this whole speaker vote, et cetera. I mean, it seems like the Republicans aren't unified, and that could end up being a little bit of a problem. And now they're debating whether to have the tax cuts as part of one big, beautiful bill or have 2 separate bills, in which case, Wall Street's going to be sit there tapping its fingers on the table, waiting for the tax cuts through months of deliberation, which I would guess would be fairly nerve-wracking. So to me, it feels like there's been this anticipation of this perfect sort of nirvana scenario from valuations that were already extremely stretched, leaving basically no margin for error in a world where I think the prospect of error is extremely high. But that's me. I tend to be fairly cynical. I am excited about the policies of this administration, and I really share the optimism that they'll be able to be implemented in the manner in which they've been outlined. So I share all of that. I'm not in any way here to say this is harebrained stuff and I hope it doesn't succeed. Quite the contrary. I'm 100% on board with, almost all of the policy proposals. That said, I do think that these policies are not without some negative consequence that we need to contemplate, at least in the near term. And I would say the most obvious is that if you're talking about sweeping deregulation, tax cuts, and these real pro-growth policies that are going to stimulate growth, you're talking about an environment where, as we just discussed, we have inflation above the Fed's target by almost 3 full percentage points on the current run rate. That's probably going to continue to be moving out of reach rather than toward them if growth is accelerating. And that would suggest an environment where the level of interest rates will be higher for longer. And to my mind, that is the single biggest risk to the markets that people aren't focused on. And I know I'm a broken record, and we've talked about this a million times before, but the impact of higher for longer interest rates is so massive, so widespread, and negative for corporate profits, for credit quality, for, basically everything. Who knows what happens in the financial sector? sector. We have this massive shadow banking system, private credit, private debt that relies on mountains of leverage, and we have no visibility into what's going on there. But presumably the credit quality deterioration we're seeing in the public markets is every bit as bad, if not worse, in that segment, with potential repercussions that, are unknowable, but surely not good. So I think that's the biggest concern I have, is that we end up having pro-growth policies that are bullish for the economy, but end up being very negative for financial assets because they sustain higher interest rates on an economy and financial system that's just so incredibly levered that becomes an issue. So I have to separate my optimism about the economy from what I view as a major headwind to the markets. But, as relates to your points about, the cost of deporting illegal aliens, obviously I think about my landscaper here. Everyone who works for him is an illegal alien. And I know that if he has to hire people who are documented, my monthly landscape bill is going to go up a lot, because he's going to have to pay these people a lot more money, and not to mention doing all kinds of additional paperwork, I'm sure. So that too will be inflationary in the near term. In the long run, sure, it'll be great because it'll get more people who maybe, have given up on looking for work in off the sidelines and help boost economic activity organically here in the country. But there are a lot of near-term costs to implementing these changes. I definitely think that will be the case, that inflation in the economy will beget disinflation in financial assets. And, we started to see beginnings of that last year with commodities, or gold in particular, outperforming the stock market. So it's clear that you already have an environment where, in real terms, paper assets are losing ground. So now the question is, will we reach a point where in nominal terms they start to lose ground? I think they may, but for sure, in real terms, we'll have another rough year, I would expect.